Beginner traders have to overcome several difficulties to become profitable. In this video, I will explain what those difficulties are and how you can overcome them with little or no effort. I will also talk about different trading strategies that will help you create a career out of trading. You may blow up account after account if you do not take trading as seriously as to make a career out of it. The first difficulty beginner traders face is putting together enough capital for trading. You may have seen many traders on the internet to make a lot of money. You may have seen them trade with tens or hundreds of thousands of dollars. But you do not have to begin trading with so much capital. You should never start with more than $10,000. I would even go as far as to say that beginner traders should not have more than $5,000 in their trading accounts until they have been able to establish a profitable trading system. Would you employ someone for a safety-critical job if that person has no prior experience or certification of being able to complete that job successfully? I guess not. But allowing yourself to trade a huge fund is doing exactly that. Learn to trade. Learn the tricks and twists of the trade, and when you have a proven record of winning trades constantly, scale up your capital. But what kind of trading will you do with $5,000? This is the second problem beginner traders face. There are two answers to that. Number one, swing trading, and number two, day trading. If you are an absolute beginner, you will not do day trading. You will trade on a minimum of 15-minute chart. It is even better if you trade on an hourly chart. That will give you enough time to look at the chart with scrutiny. You will see a bigger picture of the market. You will know how the market came to arrive at the price level it is today and now. It will also give you some idea of the recent swing highs and swing lows, in other words, the market structure, so that you can imagine where the price might make a move in the coming hours or days. The market is changing every moment, but you will not rush. You will have enough time to explain the trade to yourself and validate it. By that I mean you will answer questions like why you think your trade will be a winner and not a loser. You will wait for the candle to end before placing a trade, which will allow you more than enough time to analyze your trade. The moment you have entered the trade, you are a part of the market, and your decision, right or wrong, will affect your account. That is why you need to analyze the trade before becoming a part of the live price action. If you are not an absolute beginner, for example, you have completed at least 50 or 100 swing trades, and you are happy with the winning ratio, you may proceed to day trading. But you don't have to. I know many traders, many successful traders, who are only swing traders and who make big money every month. You cannot convince them to be day traders. They want to trade less, as little as possible, to make as much money as they can. If you can make $10,000 with 3 trades, why would you need to trade 10 times or 50 times more than that to make the same amount of money? In fact, the more you trade, the more you have to be correct to earn money, which is a challenge to every trader and a big challenge to a new trader. But if you are determined to be a day trader, what time frame will you use? This is another difficulty beginner traders face. You may use a 5-minute chart or a 1-minute chart. You will take advantage of micro moves within a move. You will make smaller amounts every trade, but will still make a lot of money if you execute your strategy well and if your strategy is supported by solid backtest data. You will exit the market many times because moves on 1-minute or 5-minute charts are relatively shorter than those offered by higher time frames. You have noticed that I have been talking about strategies a lot. That is correct. You need a business plan to run a business. In the same way, you need a trading strategy before starting trading. You can simplify the analogy further. You need rail tracks to run a train. Having a well-defined trading strategy is that important. If you do not have a trading strategy, you may lose a lot of money, eventually blowing up your account. About 80% of beginner traders do that. You may win some trades and make some money, but that can be the result of your luck favoring you or the market favoring you. That may not be a mathematically proven result based on a clearly outlined trading strategy. After a few wins, one day you will be in a trade that will wipe out all the gains you have made. 1, 2, or 3 losing trades are enough to destroy your account and for you to hate trading for the rest of your life. Winning without a strategy or system does not become a part of your conscious trading memory. You need data based on well-executed trades to take trading as a career. You see, every winning or losing trade is the result of a host of decisions. As a trader, you make those decisions and you make them before you enter a trade. A trade only plays out what you have already decided in your head. A trade does not decide itself. If you think it does, you are wrong. A trade is your means of engaging with the market. But the market is something that as a retail trader, you do not control. What you may control is your decisions. It is you who decides what the rules of your engagement with the market will be. Let me simplify this further for you. Ask yourself, why should you enter the market at this price level and not at another price level? Why should you buy a stock instead of selling or shorting it? And why do you think the trade will be a success instead of a loser? Getting confused at this point is very easy, but making your trades more complicated than they should be is easier than that. When you look at the market, you need to understand it fast, and you need to see the trade in your head fast. If you have a complicated trading strategy to execute, you may not execute it well, losing money in the long run. Or you may not execute it at all, thus trading remaining an illusion to you. Moreover, if you try to implement a trading strategy that you do not clearly understand, or you vaguely understand, you may ultimately be in a losing trade, ushering suffering upon yourself. In this regard, I suggest 2 specific solutions. If you are an absolute beginner trader, you will follow what I call the comprehensive market trend strategy. If you have some trading experience and are profitable, you will follow the price action strategy. By this time, you have decided whether you want to be a swing trader or a day trader. Whatever it is now, choose one of these 2 trading strategies to enter and exit the market with confidence. The comprehensive market trend strategy includes understanding where the market is headed. It is not an easy task, but you can start with a point of reference. That point of reference is called bias, your bias about the market. What do you see when you look at the chart? The market goes up and down. While that is true, it is far more accurate to say that the market goes up and down at least 70% of the time by following some rules. One of those major rules can be stated thus: a bullish market will remain bullish and a bearish market bearish for the unforeseeable future. You can say a market that made a higher high yesterday will make an even higher high today, and a market that fell yesterday will fall further today. The bullish nature of the bull market and the bearish nature of the bear market will continue until a catalyst works on them and changes their course. To further simplify this, you will only go long and avoid short sells if the overall market trend is bullish, and you will only short sell and avoid going long if the overall market trend is bearish. The overall market trend can be determined by looking at a higher time frame chart. For example, if you trade on an hourly chart, look at the daily chart to see the market trend. And if you trade on a 15-minute chart, look at the 4-hour chart to determine the market trend. If you trade on a 5-minute or 1-minute chart, look at the hourly chart. A market may be bullish on a 15-minute chart, but that bullishness may not survive for long if the market trend on the 4-hour chart is bearish. Smaller time frames ultimately succumb to longer time frames in most cases. We can identify the market trend by using trading indicators. If you have decided to be a swing trader, you will use 2 moving averages on your chart. On the contrary, if you have decided to be a day trader, you will use 3 moving averages on your chart. In both cases, you will use RSI or Relative Strength Index as a momentum indicator to analyze the overbought or oversold condition of a stock. For swing trading, you will apply a 200-period simple moving average and a 50-period simple moving average to your chart. You will buy a stock or crypto or forex or index fund when the 50-period simple moving average is above the 200-period simple moving average and the price rises above the 50-period simple moving average from below it. At the same time, make sure that the RSI value has increased to at least 50 from the oversold condition. In the same way, you may short a stock or an asset when its price crosses below the 50-period simple moving average. The 50-period simple moving average is under the 200-period simple moving average, and the RSI value crosses below 50 from the overbought condition. For both long and short trades, I recommend a 2% stop loss for beginner traders. Many highly conservative traders do only 0.5%, but if you do not have a premium setup based on price action, which we will discuss next, you should use a 2% stop loss. To put it in context, if you buy $100 stocks, your stop loss will be at $98. If you buy $10 stocks, your stop loss will be at $9.80. In the same way, if you short sell $100 stocks, your stop loss will be at $102. And if you short $10 stocks, your stop loss will be at $10.20. For swing trades, your profit target will vary based on the market. Target at least twice the money you risk. That is a 4% reward for a 2% risk, and reposition your stop loss at the break-even when the profit reaches 2%. Reposition your stop loss for every 2% move in the market in favor of your trade. Do not exit the market. Let the market take you out. For day trading, add a 20-period simple moving average to the above setup and use a 5-minute or 1-minute chart. Avoid trading on 1-minute charts as much as possible. The strategy is the 50-period simple moving average will be above the 200-period simple moving average, and the 20-period simple moving average will be above the 50-period simple moving average, while the price will cross above the 20-period simple moving average for a long trade. For short selling, 50 will be under 200, and 20 will be under 50, while the price will cross below the 20-period simple moving average. The RSI value, stop loss, and profit target will remain the same. This setup is the least complicated trading setup out there, but it is also one of the most profitable trading setups you can imagine. You will win 65 to 70% of your trades, which is an excellent win rate. You will be a profitable trader if you win even 50% of your trades, if you let your winners run and maintain the stop loss mentioned above strictly. The second strategy may be complicated for entry-level or beginner traders, but I will try to give you the gist of it so that one day you explore it and master it. I can tell you that this strategy, the price action strategy, offers you the most precise entry and exit points for your trades. If you truly want to take trading as a career, sooner or later, you will have to understand price action. The price action strategy revolves around one simple concept: smart money. Smart money is another name for institutional money. As a retail trader, you cannot influence the market, but institutional traders can, because they have millions or even billions of dollars at their disposal. They can push the market up, they can pull the market down. Smart money concepts tell you how institutional money behaves in the market, what they are looking for, how they establish and realize their trading goals, and much more. But they leave some trails behind. If you can identify where they have open orders and where they might exit their trades, you may position yourself better in the market and profit from the smart money's movements. Price action strategies often include bull flags, support and resistance, and breakouts. In a video I recently posted, I illustrate how price action works. I consider the bull flag strategy one of the best 3 trading strategies of all time. However, if you are a highly technical individual, you may check out the ICT trading strategies. ICT, or the Inner Circle Trader trading strategies, are highly sophisticated and highly effective. They offer superior trading setups that you won't find anywhere else. I trade with ICT strategies. I am so fond of them that I have spent hundreds of hours experimenting with them, the result of which are the 4 instruction videos I made on the ICT for my channel. This video is about the order block strategy. This video is about the silver bullet strategy. This video is about the turtle soup strategy. They are all linked in the description below. Go check them out to improve your trading today. Most retail traders lose money in the market because they do not improve their trading constantly. They do not learn from their mistakes. They hope that they will win a trade, and when they do, they think they are smart. They know trading. They consider that their intuition was right. They lose trade after trade, but fall short of accepting their mistakes and that they need to learn how to be consistently profitable. They trade until they cannot anymore. They do not depend on data. They do not wait for high probability setups. In other words, they do not intend to be professional traders. To be profitable as a trader, you need to be absorbed by the thought of trading as an indispensable act of your life. You have to tell yourself that you cannot lose. You have to tell yourself that you are not made to remain at the mercy of the market. If the market turns against you, you have to accept your defeat with cold-blooded ferociousness, as if nothing has happened, and move on. Both the comprehensive market trend and price action strategies offer you over 65% win rates. Numbers matter in trading. If you lose a trade, take it positively, because out of 100 trades, you are now 1 trade closer to being a profitable trader. You are now a well-thought trade, more experienced than before, and therefore closer and more determined than before to succeed as a trader. It is only a matter of time before money, serious money, begins to come in.